let me continue moving forward and start talking about our recap of the market for 2020. So we went through COVID. That was a big impact, but let's go back and look at the economic indicators. When we were in January of last year, boy, we thought things looked pretty good. If you remember, green is things are in good shape, yellow dials is cautionary, and red is not good. So at the beginning of last year, we were riding pretty well. The only things that were red was political unrest and geopolitical risk that was going on, which was pretty standard. That's been that way for years. But the rest of the economy, when you're looking at the labor markets, the consumer spending, interest rates, things like that, things look pretty darn good at the beginning of the year. However, literally 2 months later, the whole picture changed with COVID coming on the scene and the decision to shut down the economy. So we were not looking good at this point. Many things turned negative with the economy shutting down. The labor market went dead. The housing market stopped. Basically, people weren't even able to show homes during this period if they wanted to sell. Consumer sentiment, terrible, right? People just didn't know where we were going. However, where did we end the year up? An amazing turnaround. In fact, this was the shortest recession and recovery in the history of the United States. Okay, and a lot of that was due to the fiscal response of the government to pump money into the economy, to drop interest rates. We're going to go into that in a little bit more detail. But where we ended up the year, things were looking pretty good coming into 2021. When we recap the broad markets, this is the US market, the international markets. What you can see is the first quarter, Q1, everything was down because of the pandemic. But look how fast things turned around. By Q2, we saw US equities leading the path. International had bounced back, emerging market had bounced back, and the bond market had regained some strength in the second quarter. And that continued through the third and fourth quarter to where, if you look all the way to the right, your year to date, where we ended up, US equities very strong, international equities not bad, 8.3, but the emerging market actually outperformed the US market in last year. And then the bond market stabilized and had quite a good return, the blue bars here at the right side of the screen. So overall, 2020, with everything that took place, unprecedented situation of actually closing economies around the world, turned around pretty significantly due to the government response around the world.
But I find that incredible because at the end of the day, it was such a horrible year, but it could have been so much worse if the market wasn't supported the way it was.
Right. So as we go and look into a little bit deeper dive into sectors within the economy, what you can see if you focus on the left side of the screen, the S&P halfway down, the black bars, kind of represents the general overall largest 500 companies in the U.S. fared very well, ending at 18.4% up for the year. But now you can see how different parts of the economy, energy, financials, industrials, materials, and so on, how did they individually fare? And you can see energy took the biggest hit. And real estate was actually down, and that's part of the reason I think there was pent-up demand and why we're seeing such a resurgence in home prices and things like that in 2021. Now, if you look at the right side of the screen, basically this breaks down the economy based off a company's size, from small companies to mid-cap companies and large companies. You can see the large companies were the biggest winners at the top and at the very bottom. Large growth was the biggest winner of the year. That was led by a few small companies that we're going to talk about in just a minute. But overall, we worked ourselves out of a recession back into positive growth in the economy. Again, from the credit markets, you can see, and I'm only focusing on the right side of the screen here, the year ending numbers. You can see that the leader was actually long-term treasuries, because the Fed went in and bought a lot of the bond market to prop it up and to keep it from going down, kept it from defaults. So when you looked at investment grade bonds, even high yield bonds, which are traditionally risky, the fact that the government came in and bought a lot of the bond market to support the low end of it, to keep it from going down, that bolstered it and gave us positive returns in the bond market last year. We talked about what kind of recovery, if you remember back in March, April, May, June, we're saying, what kind of recovery are we going to have? Is it going to be a quick recovery, which is a V recovery? Is it going to be a U recovery, something that takes a long, drawn-out process to recover, like 2008 was? Well, it actually turned out to be what they call a K-shaped recovery. And basically, all that was saying is there was winners and there was losers last year. So the economy recovered as an overall, but many companies did not. In fact, many companies actually went out of business last year. So when you further dissect the type of recovery we had, you got to look at, well, what took place and caused the kind of recovery that we had, the short-term recovery we had. And it's because of the amount of stimulus that was pumped into the economy by the Fed. And the chart on the left, the pink area shows that literally interest rates, borrowing rates for corporations and banks went from 2.25% all the way down to zero inside of a 12-month period. That's unprecedented. And when you compare that to the blue lines, the light and blue lines, these were previous recessions and recoveries, and how fast the Fed responded by reducing interest rates. And why is that so significant? Because companies needed to borrow. And if it was too expensive to borrow, they wouldn't do it. So the fact that they could actually borrow money at zero meant they could reinvest that money at no cost to them from an interest rate standpoint and get their business going and keep their business going. So it was unprecedented recovery due to an unprecedented Fed rate cut over time to get interest rates to a place that companies can borrow and stabilize their business. So this was huge last year. You can see the comparison between previous recoveries and this one. Again, what caused the economy to come back so fast? Now, when we look at last year, what's interesting to note, especially now looking back at it, the biggest recovery really was supported by the 6 largest tech companies in the United States. And that's what this blue bars are representing. When you look at last year, the majority of the return came from Facebook, Apple, Netflix, Amazon, Microsoft, and Alphabet, which is Google. Those companies led us out of the recession. When you look at the orange, that was the other 494 companies in the S&P. Didn't fare as well. In fact, some actually lost, which you don't see in that net number. But overall, 6 companies were the main contributors to last year's index performance. And when you look at the right side of the screen, this represents the international market. And what you see there is the top 20 companies in Europe basically led the way for Europe to come out of the recession too, with the remaining 128 companies only doing about 14%, while the top 20 returned about 47% for the year. So technology drove the market last year and helped the recovery.
Yeah, that was part of the K that went up, right?
Yep, that was the K, the upside of the K. The other thing is when we looked at what took place from a consumer and business standpoint on how individuals and businesses felt about the market, the black line represents the University of Michigan consumer sentiment. You can see how it dropped off completely from really historically high optimism going into the 2020 all the way down, dropped more than half down in consumer sentiment, but also small businesses totally dropped off. But because of the stimulus, because of ability for companies to borrow, the stimulus checks that started coming out, all that bolstered the economy and improved people's feeling about how fast of a recovery we could have. And you know the consumer drives much of what goes on in the United States. Consumer spending is at the core of our economy.